The direction of the US dollar in the coming month is closely tied to inflation trends and to the interest rate signals coming from the Federal Reserve. These two factors play a central role in shaping investor expectations, capital flows, and overall confidence in the dollar. Because the US dollar is the world's primary reserve currency, even small changes in inflation data or Federal Reserve messaging can have a significant impact on global financial markets. Inflation data is one of the most closely watched economic indicators by currency traders and investors. When inflation remains elevated, it signals that prices across the economy are rising faster than expected. In such situations, the Federal Reserve is often pressured to keep interest rates high or consider further rate increases. Higher interest rates are designed to slow down economic activity by making borrowing more expensive and encouraging saving. For the dollar, this environment is generally supportive because higher yields make dollar-denominated assets more attractive to investors worldwide. Interest rate differentials between countries are a major driver of currency movements. When U.S. interest rates are higher than those in other major economies, global investors are incentivized to move capital into U.S. markets to capture better returns. This inflow of capital increases demand for the U.S. dollar, pushing its value higher. Even the expectation that rates will remain elevated for longer can be enough to support the dollar, as markets tend to price in future conditions ahead of time. Federal Reserve communication, often referred to as forward guidance, is just as important as actual policy decisions. Statements from Federal Reserve officials, meeting minutes, and press conferences are carefully analyzed for clues about future interest rate paths. If the Fed adopts a hawkish tone, indicating concern about inflation and a willingness to keep rates high, the dollar typically strengthens. Conversely, a dovish tone suggesting rate cuts or easing monetary policy can weaken the dollar, even if inflation remains relatively high. Another important factor is how inflation data compares to market expectations. If inflation comes in higher than forecast, it can trigger a sharp reaction in currency markets, strengthening the dollar as traders adjust their expectations for interest rates. On the other hand, if inflation shows signs of cooling faster than expected, markets may anticipate future rate cuts, leading to a weaker dollar. These short-term reactions can create significant volatility in the dollar's price over a single month. The relationship between inflation and interest rates also affects investor confidence in the U.S. economy. Controlled inflation with steady growth is generally viewed as a positive sign, supporting the dollar. For example, if the European Central Bank or the Bank of Japan maintains lower interest rates, the dollar becomes even more attractive due to the yield advantage. This relative strength plays a key role in determining the dollar's direction in the short term. Bond markets also provide important signals. Rising U.S. Treasury yields often indicate expectations of higher interest rates or persistent inflation. When yields rise, foreign investors buying U.S. bonds must purchase dollars, increasing demand for the currency. This mechanism can quickly push the dollar higher, especially if global yields remain comparatively low. Conversely, falling yields may signal expectations of rate cuts, which can weaken the dollar. Short-term dollar movements are also influenced by speculative positioning in the currency markets. Traders frequently adjust their positions based on inflation reports and Federal Reserve statements. If speculative positioning becomes heavily skewed toward a stronger dollar, even positive news may have a limited impact, as much of the optimism is already priced in. On the other hand, unexpected hawkish signals can trigger rapid buying and sharp upward moves. The strength of the dollar driven by high interest rates has broader global implications. A stronger dollar makes imports cheaper for U.S. consumers, but increases the cost of dollar-denominated debt for other countries. Emerging markets, in particular, can feel pressure when the dollar strengthens, as capital flows back to the U.S. in search of higher returns. This dynamic reinforces the dollar's role as a global anchor currency. However, it is important to recognize that interest rates alone do not guarantee long-term dollar strength. If high rates begin to significantly slow the U.S. economy, markets may shift their focus toward future growth risks. In such scenarios, even elevated inflation may not be enough to support the dollar if investors anticipate a policy reversal or economic downturn. Therefore, the balance between inflation control and economic growth is critical. In the coming month, much will depend on how inflation data evolves and how the Federal Reserve responds. If inflation remains stubbornly high and the Fed signals that rates will stay elevated for longer, the dollar is likely to remain strong or even appreciate further. This environment favors yield-seeking investors and supports continued demand for dollar-denominated assets. In conclusion, the U.S. dollar's short-term direction is heavily influenced by inflation data and interest rate signals from the Federal Reserve. Elevated inflation and a hawkish Fed stance generally strengthen the dollar by attracting global capital and increasing demand for higher yields. Market expectations, central bank communication, and global interest rate comparisons all play a role in shaping this movement. As long as inflation pressures persist, and the Fed maintains a firm stance, the dollar is likely to remain supported in the near term. Global risk conditions and overall market sentiment play a decisive role in shaping the U.S. dollar's short-term movements. While inflation and interest rates set the broader direction, shifts in investor psychology often determine how the dollar behaves day to day or week to week. Because the U.S. dollar sits at the center of the global financial system, it is uniquely positioned to benefit during times of uncertainty and to face pressure when investors feel confident enough to take on greater risk. During periods of global economic uncertainty, investors tend to prioritize safety over returns. This behavior is commonly referred to as risk-off sentiment. In such environments, capital flows out of riskier assets such as stocks, emerging market currencies, and high-yield investments and moves into safer, more liquid assets. The U.S. dollar, supported by deep financial markets, strong institutions, and its status as the world's primary reserve currency, becomes a natural destination for this capital. As demand for the dollar increases, its value strengthens in the short term. Geopolitical tensions are a major trigger for risk-off behavior. Conflicts, trade disputes, sanctions, and political instability can quickly unsettle global markets. When uncertainty rises, investors seek assets that can preserve value and provide liquidity in times of stress. U.S. Treasury bonds, which are backed by the U.S. government, are often considered one of the safest investments in the world. To purchase these bonds, investors must buy U.S. dollars, which directly increases demand for the currency and supports its price. Global financial stress events also amplify the dollar's safe haven role. Banking crises, debt defaults, or sharp market corrections can cause sudden spikes in dollar demand. In such situations, even countries with strong economic fundamentals may see their currencies weaken as investors rush into the dollar. This phenomenon highlights the dollar's unique position as a global safety net during times of crisis. Market sentiment is heavily influenced by news flow and expectations. Economic data releases, central bank announcements, and geopolitical developments can quickly shift sentiment from risk on to risk off. For example, weaker than expected global growth data may increase fears of recession, prompting investors to reduce exposure to risk assets. In response, the dollar often strengthens as capital seeks safety. Conversely, when global markets are optimistic and confidence improves, the dollar may face downward pressure. This environment is known as risk-on sentiment. During risk-on periods, investors are more willing to pursue higher returns by investing in stocks, commodities, and emerging market assets. Capital flows out of safe haven currencies like the U.S. dollar and into higher yielding or growth-oriented assets. As a result, demand for the dollar can weaken in the short term. Commodity markets also play a role in shaping risk sentiment and dollar demand. Many commodities, including oil and gold, are priced in U.S. dollars. During risk-on periods, rising commodity prices may reflect stronger global growth expectations, which can weaken the dollar as investors diversify away from safe assets. On the other hand, during risk-off periods, falling commodity prices and economic uncertainty often support the dollar's strength. Another key factor is global liquidity. During times of stress, demand for dollar liquidity increases as institutions and governments seek to meet dollar-denominated obligations. This phenomenon, sometimes referred to as a dollar squeeze, can cause rapid dollar appreciation. Central banks around the world closely monitor these conditions and may coordinate to provide dollar liquidity during extreme stress, further underscoring the dollar's central role. Market sentiment is also shaped by investor positioning and psychology. When investors are heavily positioned against the dollar during optimistic periods, even small negative developments can trigger rapid reversals. These sudden shifts can cause sharp, short-term moves in the dollar, as traders rush to unwind positions and seek safety. This makes the dollar particularly sensitive to changes in sentiment over short-time horizons. It is important to note that the dollar's safe haven status does not mean it will always strengthen during uncertainty. In some cases, concerns specifically related to the U.S. economy or political environment can limit the dollar's appeal. However, in most global risk events, the dollar tends to outperform due to its liquidity, stability, and widespread acceptance. Short-term dollar movements driven by risk sentiment often occur independently of underlying economic fundamentals. Even if inflation is stable or interest rates remain unchanged, sudden changes in global confidence can push the dollar higher or lower within days. This is why traders and investors closely monitor global news, geopolitical developments, and market volatility indicators. In the coming month, global risk factors such as geopolitical tensions, economic growth concerns, and financial market stability will play a crucial role in determining the dollar's direction. If uncertainty increases, the dollar is likely to benefit from its safe haven appeal. If confidence improves and markets shift toward risk-taking, the dollar may experience modest weakness as capital flows into higher risk assets. In conclusion, global risk and market sentiment are powerful drivers of the U.S. dollar's short-term movements. During periods of uncertainty, the dollar strengthens as investors seek safety and liquidity. When optimism returns and risk appetite increases, demand for the dollar may ease as capital flows elsewhere. Understanding these dynamics is essential for anticipating short-term dollar trends and navigating currency markets effectively.